Hello, everyone. I'm Jim Garrison, and I want to welcome you to day 35 of Humanity Rising. Every day since the 22nd of May, between 5 o'clock and 7 o'clock p.m. Central European Time, we've provided a 2-hour block of common ground for people literally all over the world to come together to share their experiences and reflections about this extraordinary pandemic that we're all going through. And most fundamentally, to take counsel about how we can interact with more effectiveness so that we can actually make a difference in the post-pandemic world. All of us know that the world teeters on the precipice. Today is one of the hottest days of the year in Europe, and it's the hottest couple of days in recorded history in the Arctic, across Siberia. And those of you who know about climate change and methane gas, just imagine how much methane is seeping out into the atmosphere. And methane, as we know, is significantly more contributive to global warming than just CO2. So as we meet today, the crisis gets worse. And scientists are telling us that we have only a few years. This next decade between 2020 and 2030 will probably be the most critical decade in the history of the world. And with this pandemic, we've all gone through a similar experience. We're all in some form of lockdown still after months of lockdown. The states around the world that are opening up are seeing resurgence in cases. And extraordinarily, the entire world is in the same conversation thereby. So part of the motivation of Humanity Rising at this moment where everybody knows what the issue is to really delve as deeply as we can into conversations that truly matter in this time. And then to seek to transform those conversations into actions that make a difference. Today, we're going to take up one of the most perplexing and intractable issues, and that is the rank hypocrisy of our corporate and capital market sector. If you watch television or get the advertisements almost from any source, you'll hear that Mobil Oil, Monsanto, various companies that we know are engaging in toxic pollution or oil drilling. We see all kinds of advertisements that they are totally committed to a regenerative economy and that they're essentially as committed as anyone to the greening of the world. When the reality is they are not. They're contributing to the crisis that we face because their principal motivation is profit. And whatever they say about being socially responsible or the triple bottom line of profit, planet, and people, the reality of the economic situation in the world today, with a number of very important exceptions, which we'll get into, is virtually a stampede to garner as much profit at the expense of planet and community as they possibly can. And even when ordered by government to be more sustainable, they find ways not to be. And this contradiction, which is manifest not only in the corporate and economic and capital market sector, but politically, institutionally, culturally, this extraordinary disconnect in the human psyche at this moment of duress, where we know what we should be doing, and we even will say that we're doing it, but we don't. And whether it's in our personal lives and we put our money in a bank and we don't ask any questions, or we put it in a savings account, or we buy as consumers, every decision we're making has an effect on the world. I'm delighted to be able to introduce Ruth Braunwald, who is the CEO of Impact Invest, who's been thinking about these kinds of issues for many years and is a leader, not only in Sweden, but globally, in the movement to make money more accountable. She's convened a panel today. So I will now turn the floor over to you, Ruth, and thank you for joining Humanity Rising today.
Thank you. Thank you very much, Jim. And thank you so much to your team for making this happen. And I know today you've been going for over a month. It's amazing the different types of conversations that you're having, and you have promised to keep having for as long as it takes, as long as we are in this situation, you said. So I'm very pleased to be able to bring up this topic, especially a topic that we've been working on for a number of years in Scandinavia and also internationally, and delighted to have a panelist with me who are very, very experienced and are far more experienced than myself in discussing and driving the change in this industry, in the finance industry, but also with the implications for entrepreneurship, social innovation, and so forth. First and foremost, we have Lisa Kleisner with us. She is one of those pioneers and one of the role models for us as Impact Invest was founded in Scandinavia. We are based in Stockholm and London today, and Lisa is one of the co-founders of the Tonic Network. But together with her husband, Charlie Kleisner, they have been so open to disclose, to explore and experiment. How can you, with your own money, think about your own savings and investments? How can you make a difference with capital as well as with the resources? Since the Kleisner family, they have an entrepreneurial background from Silicon Valley, and to put that entrepreneurial practice into driving change, into direct investments for entrepreneurs, but also have been so generous in opening up and look at how can you deploy money in a sustainable and more impactful way across different types of asset classes. So a warm welcome to Lisa, who's today located in Big Sur this morning. Then we have Nadine Villamar. I'm very proud to see that she's one of our new board members as well. She has a long history working for the implementation of environmental, social, and governance perspectives among others, in one of the largest national pension funds in Sweden. She left about a year ago to become an ambassador really for climate change and the transition into the climate transition that we need for capital and for corporations as well, by joining the Transition Pathway Initiative. And Nadine will be sharing her perspective from the background of working for a large institutional investor tonight, but also be able to discuss and disclose some of the real interesting research and findings that the TPI did in their collaboration with London School of Economics and London Business School, I think, previously. And we were supposed also to have a man, Jan de Dood, in the Netherlands joining us. Unfortunately, due to personal circumstances, he is not able to join us tonight. And that is one of the reasons that the conference and this session right now, we will be running it for about an hour. And so if you're feeling hot and it's you're sitting here and sweating, don't worry, we're going to cut it a little bit shorter so you'll be able to do other things later tonight or today. So with that, the format is fairly simple, and we're going to improvise to let you in as well as the audience. We're going to see how, please, this is the statement for tonight. This is the opening statement and the claim that we are going to discuss. And Jim opened up really well on this notice. But the big point about this discussion that we from Impact Invest and what we want to discuss with you and engage you as participants tonight and going forward is that the financial institutions are not supporting innovation and risk mitigation for people and planet to the extent needed. This very week, the UN is celebrating 75 years and going into these sustainable development goals, again, to emphasize the need of funding for the 17 sustainable development goals. With the pandemic that we're experiencing, it's not needless to say that some of these funding gaps are getting even bigger. And I'd also like to refer, for those of you who have listened to some of the previous sessions and participated in the conference maybe last week, the sessions around last week was about enterprise and the business role in driving social change. And that was led by Peter Mary. And he pointed out that why business is so important to drive change is that businesses and enterprises, of course, are used to taking risk and to experiment. But in order to do so, they will often need capital and funding in order to develop the businesses models, the new technologies, more inclusive and diverse organizations, etc. And those that have capital and manage the capital have not been as willing to take on and share such risks. And the outcry from the public and regulation that followed the financial crisis has also brought some possibly unintended consequences, as the banks need to explain their products and services in more detail, in a more transparent way, and make consumers aware of risks, what risks are associated with the different investments options and with pensions funds and with savings and so forth. It has, from our point of view at Impact Invest, it has put a big, massive lid on the financial community's ability to, for example, to innovate around and put money towards organizations that are not traded on stock exchanges with daily high volumes. Most of the pension funds and the funds we see in Europe have that restriction. They can only be traded on the stock exchanges, and therefore we're limited in the choices made. Another example is, where would we see the opportunities as we have within development finance and within impact finance? It's key to put the financing in relation to environmental and social outcomes. How can normal consumers see that, find those type of products? The banking and the institutions have not innovated to connect the terms of financing to outcomes rather than only the economic KPIs. The last example here is also to then channel, as I initially said about this argument and the funding needs, the channel capital to the most underfunded SDGs. Most notably, we only need to consider goal number 1, zero hunger. What is happening with the heat waves and what is happening in the aftermath of the epidemics as we're going through that. I'm going to show you just 2 slides. I'm not going to get too theoretical, but I want to show you just the status for why would I say this? Why do I make that kind of statement and opening for that? For example, data from the World Research Institute that you see here. This is from last year. And this is taking a snapshot from the 50 largest banks in the world. 23 of them have made disclosure. 23 of them made disclosure last year on their commitment to sustainable finance. And as you can see, just take the largest one. you have Mitsubishi Financial Group is one of the banks that made the largest commitments. The annualized is what you see in the yellow panel here, if you take it 1 year after another. Now the total turnover, the assets that a group like Mitsubishi is managing is nearly $3 trillion. Think about that number, $3 trillion. And you're looking at a commitment about 26 billion. So you put that in proportion. All of these banks are making less commitment than about 10% of the total assets that they manage, less than 10%. And as I said, if 23 are disclosing, it means the rest are not disclosing and maybe doing far less, if anything. Of the banks that are putting more money, putting higher commitment to sustainable finance compared to the funding of fossil intense activities, there are very few. It's very, very easy to list them, and you see them here. There might be more banks doing that now. There have been a number of announcements, but you see, we have 6 banks, only of the largest banks in the world, only 6 banks have more commitment to sustainable finance than to fossil fuel funding. So the Nordic markets, just a couple of big words. Now, actually, I'm going to just say there, I'm going to actually bring it back one slide to say, many of you, I'm sure, are aware that also there were some large announcements in January from BlackRock and from Goldman Sachs. And of course, that's also interesting because, for example, Goldman Sachs, they had much larger numbers. They put in a commitment and said, we're committed to moving $750 billion over the next decade. And as we go through and we look into those kind of themes, they have listed these 9 different themes into 2 different pillars around the climate transition and also about inclusive growth. If you go to the website, it's quite interesting to look at what are the examples they bring up in terms of the funding that they see within sustainable finance. For us that work with entrepreneurship and who work with those organizations that are committed to innovating new solutions and come up with new business models, etc. I was intrigued to find that out of these 9 case studies, 7 were private companies, one of which was Northvolt here in Sweden. And the 2 others were actually non-profits. One was a conservation fund. And then we had also a community development organization. So I thought that was quite fascinating to see that when we look at an initiative of that size, they do concur with that perhaps argument that the innovators, those who really contribute to the change, they are actually newer, younger company, and they are organizations in those markets where you don't see the largest stock exchanges. So with that, I'm going to stop here and not say so much more just about the initial remarks there in comments, but I'd like to hear from our panelists and to see, do you support this view? What do you see in the banking sector happening? And just share your views with us on this question about the ability to innovate and how far sustainable finance has really come. So Lisa for that question.
For me, it's a good morning to everyone. And for Ruth, I'm sure it's a good afternoon or good evening. Well, so I think it's always difficult to innovate within a system. I think we see enough examples of that. You know, there are lots of exceptions, of course, but I think particularly in the banking industry, because of the policy overlay that's pretty draconian, I think that's a global problem. It's very difficult for mainline banks to really have strong innovation entrepreneurial programs. The banking, you know, when we went about the task of moving our capital into more values aligned institutions, it took us a long time to find cash alternatives. And I think that that's still true today for most investors, and particularly for retail investors. In fact, even when we did find a bank that was values aligned, and they're a member of the Global Alliance for Banking on Values, which is a really interesting organization. It's online, and it will give you a list of banks globally that if you're listening to this and you're wanting to shift to a bank that may be more in tune with your perspective, I would definitely check that list out. So we went to a bank in San Francisco, and they didn't have enough services. And so a lot of the values aligned banks are not really set up to address the retail clientele, much less private banking needs. And I'm proud to say that the bank that we decided to choose, and this was against the wishes of our financial advisor, of our investment advisor, everyone was against it because of the lack of services. They actually decided to create a private banking arm as a result of our request, and that allowed them to bring in other clients and to provide those services. So I do think this isn't about us waiting for the market to show up. This is really about us building and creating that market. We have to show up. The consumer has to show up first and ask for those services and stand firm until we get them, which is what my husband and I did. We basically we were not going to move banks until we could find the bank that was going to work with us. So, so some other points that you made around the how these large banks are basically slow to move on moving beyond ESG. So let's just pause for a minute on ESG, right? What is ESG? Well, ESG is it's more about how the particular investment is doing its business. It has nothing to do with the impact that it's having. In fact, that's why the SDGs are so critical. That if we have a company where we can measure the ESG and the SDG, I would say both are important, that the collective net effect of that will be you're going to have the how, which hopefully is more sustainable. And then you're also going to have a clear link to the what, that is the what you want to achieve, and to the outcomes, the type of impact that you want, and also to the who, right? Who are the beneficiaries? Who's being impacted? So the banks just are not, this is not how they think. I recently listened to a hedge fund pitch. This was an impact hedge fund that was designed by a couple of folks that left Goldman Sachs. And I realized as I listened to their pitch that they saw it as an evolution of ESG, that their thinking, this evolution was more impactful than ESG pure, but any sort of iterative form of ESG is not impactful from our perspective. And I think hedge funds generally are just from a concept or from a strategy perspective don't fit in our portfolio because someone is going to lose in that process. It's not about trying to figure out how to be the best in class on reducing carbon emissions, benefiting communities, providing, sharing, being inclusive in ownership, and all these other sort of localism and regionalism models that my husband and I really subscribe to. And so big banks are just not designed to work that way. Small local banks are, they have to. And the reason for that is because their clientele demand it. That basically is who's walking in and out of the door on a daily basis. But they struggle. So, one of the things that you didn't mention, Ruth, is the fact that on the retail side, retail banks are being disintermediated by online banking. And online banking is really revolutionizing, changing the relationship between the person with the account and the bank. And on the one hand, it might be good because it's more efficient, it's cost effective. But on the other hand, now all of a sudden we have a very arm's length relationship with our bankers, and a very difficult, I think that then makes the conversation around impact and community engagement even more difficult. So I'm going to pause there because I know that Nadine has probably a perspective on the institutional side of the equation.
Thank you, Lisa. Yes, we will hand over to Nadine. I'm just going to put the screen on for 2 seconds just to let those who have joined the conversation just to know what are the questions we are discussing in this session and a little bit of running order of things. We're going to go for about an hour, so we're going to also come to more of those, come back to more of those practical questions. What should you look for? What should you ask your bank manager? So yes, Nadine, please.
Thank you very much, and good morning, good evening, everyone. Just as a matter of background about what I will talk about and evidence, see how slow things are moving. Give you just a small background of the TPI Transition Pathway Initiative that I've been engaged with since 2016 in my previous role, but as director since the beginning of 2019. So TPI really is an asset owner-led initiative that was launched at the beginning of 2017, and really to help investors to understand how the large corporates are preparing for the transition to a low carbon economy. So it's still an asset owner-led initiative. It's financed mainly by asset owners. We provide data for free. In the chat, I have already shared the webpage and the report I will refer to if you want to see details. But that's really the background. And now we are supported by close to 80 institutional investors with $20 trillion under management. Our data is used with another 450 investors that engage with 160 of the companies that we cover to make them move. And what we do, the Transition Pathway Initiative, is about looking at high carbon emitting sectors, and we look at the carbon emission throughout the life cycle of the product. So that's our prime focus. And this initiative was initiated by Church of England, investment bodies, and environmental agency pension fund, who led the way and made this happen. And to do the assessment, our strategic partner is the Grantham Institute at the London School of Economics, having developed the methodology and performing the assessment of the companies. And we look at two different dimensions. I will mostly concentrate on the most difficult one, which is called carbon performance, and that's about looking at how well the targets companies hopefully have set, and if they have not set carbon emission targets, at least where they stand today, and compare that to where they should be for their sector in terms of alignment to the Paris Agreement or 2 degrees. The other dimension that we look at is management quality, and it's really about what infrastructure does the company have in place to make this happen. And they are not fully correlated. You can be good at management quality and very poor in carbon performance, but we have examples the other way around. So what I refer to now is this report, the State of Transition report that TPI published in March, making a summary of the full universe that we cover. We cover over 300 high-emitting companies that we have assessed. And this report is really a summary of where these really large companies stand in 16 different sectors in terms of the transition to a low-carbon economy. And just to make sure, our assessment relies only on publicly available data, and you can find all the details for free on our web. So what did we find? If we go first to the maybe less interesting part, but still an interesting one, is the management quality part. It's easier to check boxes in the management quality part. Of the universe of over 300 companies, more than 60% do quite well in management quality. They have level 3 or 4 out of 4 possible, but we have another 40% that really haven't got a clue yet, that are below 3. So even there is a positive message that 60% or 62% have started their journey, 40% have not. So that's the good news, because the bad news is when we look at carbon performance, the picture is not that nice. Also in the report, but you can see it on this very nice graph, the red part of the graph, over 50%, is they are not aligned to even the Paris Agreement that will bring us to 3.5 degrees.
And we're talking about the world's largest companies here, the world's
largest companies in high emitting sectors. Yeah.
Can I put in a quick question there? If you look at, these are also, I suspect, some of the companies that are listed on Dow Jones Sustainability Index. Have you looked at the correlations? Are the green ones in the sustainability index, or would you see some red flag companies in your research showing up on these indexes as well?
I would say in Dow Jones Sustainability Index has a crucial problem, is that you just need to be best in class. You don't need to have a sustainable business. So they rate tobacco companies, oil and gas companies, and so on. So to be part of Dow Jones Sustainability Index does not tell you anything if your business model is sustainable or not.
So that's very much to Lisa's point then, that the ESG is not really what could ever drive and actually extend or take you forward towards impact then.
Not as long as you don't understand that you have to look at the business model. And our assessment in TPI, especially the carbon performance one, assessing if the targets of the companies are aligned with Paris or 2 degree aligned or so, or better, is one first step to look if they have the ambition to change their business models into something more sustainable. A target is not a promise, but the target is a commitment, and we can hold the company accountable to that. But at least it's a way to try to be forward-looking and not only backward-looking, because management quality really very much is about backward-looking. What things are in place, what disclosure is in place, and so on. It does not tell you anything about will they succeed or not. That's where the climate performance comes in. And as you saw in the picture, over 50% are not aligned even to the agreement of the Paris Agreement, where we will end up with 3.5 degrees. Another 15% of the universe does even not disclose to enable this kind of analysis. We have like one third of the companies that have reasonably serious and ambitious targets to move in the right direction.
So how do we, I mean, you mentioned that TPI here is set up by some large asset owners. So how did the asset owners react on this report in March? What's the response?
Well, the response is, well, the positive one is that as these large group of asset owners work together to engage these companies. One is we see small progress. We see that the really difficult ones maybe start to understand that this is a request from the asset owner community and start to take small steps. And that other companies are getting more serious about this, but very, very, of course, disappointed to see that still there is such a big amount of companies, a proportion of companies that really haven't moved the needle, and especially not set targets that shows that they understand that they have to transition from the kind of business model where they are today into where they have to be. But there are differences between the sectors that we have looked at. And one example is what we found very, very surprising was shipping, for example. We assessed shipping for the first time, and now we speak about the listed companies, and these are only 13 listed companies, but big companies, where they are the best performer in our universe, and to our surprise, but these large companies they have fleets, modern fleets, they have money to do the right things. So this was a surprise, because we all hear about shipping as being a very problematic sector, and it certainly is, because these companies are not representative of the shipping industry. These are really the bulk, the transportation of these big ships with containers, container shippers shipping, and they are as I understand double in efficiency. They are so much better than any other ships that are around, so that explains probably their very good performance as a sector. But then we have also shipping in electric utilities and paper are doing quite okay. Roughly 50% of the sector is doing fine. But and not so surprising, oil and gas is a poor performer. But we have seen this year European oil and gas companies committing to zero targets and so on. So they try to move in the right direction, but standard isn't there really. But we see in the European oil and gas market some willingness to move, whereas we don't see it at all in the US. Airlines is also another problematic one. And finally, I would say very surprising, the automobile sector, where over almost 60% of the companies that we have covered have not set ambitious targets, and regulations, especially in Europe, are getting there. So we are very surprised that that sector is not performing.
Sorry, can you repeat which sector was that? I think you broke up.
Automobiles.
Automobile, yes, yeah. So there was also a question in the chat about what companies, but you have disclosed on the transition pathway, you have the link, and for those of you who are on the, if you're watching on YouTube, etc., you can go to the tpi.org's website, and these different companies.
Transitionpathwayinitiative.org, very short.
It's the bold, I said TPI.
It's the transitionpathwayinitiative.org, and we disclose details on all the companies. You can see company by company what it looks like. Okay.
Yeah, and I'd like to share, to that point, as we have that question about, the move towards something, I'd like to share this data with you. As in this year, in the autumn and at the beginning of this year, we were researching the status of in particular the Nordic markets when it comes to funds and when it comes to what is available to the retail consumer when it comes to impact and sustainable. We didn't find one single fund that actually focused first on sustainability and impact. It just doesn't exist yet. And to that point about the global universe, that many of the funds are therefore investing in the same little pool in a way. What is the status? If we look at, I contacted the MSCI, who is doing research. They're doing research for all the listed companies on the major stock exchanges around the world. And it was interesting to see when they started doing that, one of the first research years you find here at the top here is 2016, looking at how much of the revenue, the company's exposure to sustainable impact themes. And you see their themes here, I hope you can read them. It's empowerment, basic needs according to the SDGs, climate change, natural capitals, etc. And that universe, the number of companies that had some kind of, where we can see there is the business models and the businesses related to some of these sustainable impact themes were about 1,000 in that universe. And at that point, if you look at how many are really contributing, would we say, for example, more than 50% exposure to sustainable impact themes, you find 123 plus 34. So that was about 150 out of the 1,000. Now, 3 years later, I asked them for the updated figures, numbers on this, and they pulled out the data that would turn into this graph you see at the very bottom. Now the universe, good news, the universe has fourth-folded, so 400% more companies are saying they're doing something more, and they are starting to change their businesses into something more impactful. But if we look at those who are really making significant contribution, i.e. above 50%, well, we see that you have 496 plus 155. It's about 600 companies out of a much larger universe. So it's moving, but really, really slowly. And this is what we see as one of the reasons why also the banking financial system, as long as they keep investing in equity and mainly focus on equity, because the bond market, the debt market has progressed a bit more, and there's more innovation within sustainable bonds and so forth. But the equity market is a bit of a problem, isn't it? They're still lagging. So my question is to you, where do you see some countries are still moving a little bit ahead? And that was one reason we should have had, or we had hoped to have Jan de Dood with us in the Netherlands. We have banks and we have countries that have moved ahead of the market and are really, really at the forefront. And also we see some of the French bank implementing the 90-10 fund. So you are investing 5 to 10% in social enterprises, in fair trade, in climate change, etc. But here's a question for you, because, and I would like to start with Lisa on that. The US market has many, many more products. Is that because you're more aware that finance and capital has a role to play also in the welfare and in a society compared to the welfare states in, for example, in Northern Europe? Or what's the reason that some markets move ahead and some are still very traditional, you think?
I'm not sure that I can actually answer that question, but I can just tell you what I observe. I also put in a resource into the chat box. So I've been working, I'm on was on the Tonic board. After 10 years, I stepped down. I was the board chair up until December of last year. And we have been researching the 100%, the characteristics and the behaviors and the investments of 100%ers. And as a result of that, we were able to create a directory, which includes, so we tracked a little bit shy of 4 billion in assets invested in by these investors. And then we've logged in, I think the directory has over 1,500 types of investments. It's quite the range, it's cross asset class. It's quite global in nature. And I think if anyone is interested in seeing what do people consider to be impactful that's beyond looking at the public market, I think that would be a great place to start. It has a search engine. So if you're interested in gender lens, or you wanted to look at climate, pick your theme and you can then say, but I'm in Timbuktu and I need to find all the investments in gender lens in Timbuktu. You can also find that. So I think it's a pretty good tool. Why do we see so much innovation in the US? One of the things is I think the state and the federal structure has allowed the development, I think, of more innovative banking structures. So we have, obviously the big banks that are heavily regulated, and some might argue they're not regulated enough in the right places and overregulated in the wrong places. But there's been this ability for private banks to develop and to rise or emerge that serve more values-aligned customers. And that's driven because there was enough clientele. It was not a build it and they'll come. It was build it because they're already here and there's nobody to service this community. So, and we're seeing that sort of grow. I think it started I would argue, on both of the coasts, both on the East Coast and the West Coast. And we're starting to see these types of banks emerge in Colorado. So it's usually, in all the progressive places in the United States. I would say on the product side, why do we see so much innovation? I think because we're actually investing. So governments and states are actually promoting innovation, entrepreneurship, social enterprise. And so in my home state of Hawaii, although I live in California, my home state is Hawaii. And Hawaii has been investing in, and it's a modest start, right, in a social enterprise in Hawaii that combines culture and innovation, which is, I think, a unique value proposition that they can have as looking out at the broader world. Also, they're driven quite a bit. The innovation is driven from a resource scarcity perspective, which when you're on an island and everything comes to a grinding halt because of COVID, right? Where toilet paper becomes the most expensive item, and you can't find it on the shelves. I was in Hawaii when it hit, and it's true that the shelves in Hawaii unloaded and stores had little to no product. And so folks start to innovate around this idea of scarcity, and the products that they create, the innovation that's happening there. And I also think in the US at large is, I think, driven by the support community of folks like my husband and I, who like to invest in early seed stage, who see risk differently. That's the other thing, is we look at risk not in what are we going to lose if we invest in something, but what will we not gain if we do not take the risk to make the investment. It's a very different perspective.
Yeah. And I think, I mean, to speak from my own personal experience and what we do here at the Impact Invest is also that the kind of return, I mean, when you look at in particular social return, and sometimes also from an environmental perspective, you get the return within the first year. You can see the delivery, whereas the financial return might come, especially in the early seed stage, you might get lucky and get that 6-7 years later. But the return on the impact side and sustainability, you start to see the trajectory of that quite soon after you put in that resource, right?
Excellent point, Ruth. Yes.
I'd like to shift to, if we can get even a bit more personal and private and get to your own. I'm sure that.
Sorry, Ruth.
Yes.
Can I just add? We in the TPI universe, we see that even though not products are there in terms of the companies that are good performers in carbon performance, it's Europe who has taken the lead, and that's mainly due to regulatory changes and push. So we see, for example, 58% of the European companies in our universe are aligned with at least the Paris Agreement. Whereas in Japan, it's 40%, and in North America, 26%. And for the rest of Asia, impossible to assess because there is not disclosure. So there is really a mixed picture, and regulatory push is there in Europe. And this was already back in 2018, because we assessed their reports from 2018. And that has just increased since. So there is we don't see the same picture in our.
No, absolutely. And when I said investment, the innovation in the American market, I was referring to the number of different types of products.
I understand.
That you can have, because you have more community banks, you have different types, and the banking sector is not so homogeneous as what you see in Europe, obviously. On the corporate side, I think that trend is also very visible and promising for the future when it comes to the private market as well. We see many innovators, and many of the in the private equity field and VC field, we see many that are now focused on impact for tech, and or what they're labeled, and they have more of a choice there. And hopefully one day these kind of private equity funds will also become listed, so the other larger institutions and asset manager can then invest on behalf of consumers and people who want to save in a good place for their pension. With that,
can I jump in? Can I jump into Nadine's comment? Because
Absolutely.
absolutely, Nadine, I think the Europe definitely has developed or has done some really ingenious regulatory plays to create or foster an environment for more impact. But where Europe is lagging is in the development of the intermediaries that are needed in order to move this forward. So we see this. We did a report for Tonic, again, looking at intermediaries both in the US and Europe. And there were far fewer in Europe, and they were all very pioneering, let's put it this way, and talked about how the market is really nascent. In the US, it doesn't matter where you are in the US, you will find, if you're looking for an intermediary to help you search out impact investments, impact banks, and so forth, you can find someone, and you can work across all of the states to deploy your portfolio. I think the difference really is that Europe, comes from a very social route, and when we look at the Nordics, especially Ruth, Sweden, Norway and up north. Very different approach to large business. And there was already this pre-think about how when businesses get really large, what's the social benefit to the community, and the government and the businesses step together to I think that resulted in a conversation that I think is beneficial, or we see the outcome of that in a policy in Europe. We don't have that kind of relationship in the US. And so what happens here is the movement we see that is happening in the private sector. It's not happening through government. In fact, right now, in the last 4 years, government has been an impediment. And so the private sector has really had to step up.
Yeah.
Yeah.
We have received a question.
Yeah.
Sorry, we have received question in the chat about the questions. What would we say and what would we ask to the bank manager and asset manager? And I promise you, we will try to answer that question. But before doing so, if we can tell us a little bit, move on to the consumer's perspective of this. If we go outside of the private equity, Lisa, could you tell us how easy? I know you have spent with your direct investment, it's obviously take a lot of time and engagement, but you also have savings, you have investments in other areas which is managed by somebody else. So could you tell us how easy or difficult it has been for your family to find sustainable and impactful investment? And would you have been able to do it without financial advisors?
We would not have been able to do it without financial advisors. So when we started back in 2000, first of all, no one understood to talk about having an investment that benefits the community and the environment was antithetical to the financial and the investment industry. So they didn't, that was a non-starter conversation.
They didn't understand the question, or?
Yeah, that was a non-starter. It was like, that's a great idea, little girl, but why don't you take your money and come back when you're ready to grow up and actually invest like the big boys? That was literally the conversation in Silicon Valley back then. So we put our money into a bank account and we sat on it actually right through the downturn in 2002, I think it was. Yeah. And it was only in 2004, actually, after we met Jed Emerson, that we were empowered by him that we're not going to take no for an answer. And so we started to hone what it is that we wanted. And that from that point, from 2004 forward, it took us about, I want to say 16 years to move all of our assets to 100% impact. But today, so let's map it forward. So a lot of progress.
Congratulations. You say you have achieved 100% impact.
Yeah, well, actually, we're already recycling. So we're moving from impact, right, 100%. Now we're going deeper in the impact. So we have harvesting that has happened in the portfolio. And we're looking now, so we're moving more toward private impact funds and direct investments.
Excuse me, not so familiar what you have in there. I mean, you did even look at I think more liquid in cash and currencies, and so that was one of the most difficult there, I suppose. But you have invested in things related to conservation, and it's fairly broad still, so that you have looked at different asset classes.
Yeah, no, it's true. So our objective really was to prove the thesis that impact investing can deliver returns that are competitive with the market, right? Mm-hmm. In the process of doing that, we've learned a lot about the fact that the benchmarks are malarkey, right? What they're based on has nothing to do with what we're doing. But we did prove our point, and now we're actually moving in quite a different direction. So and that's the recycling, right? We're basically moving from the investment thesis we had before to one that's focused more squarely on social justice, which this started about 4 years ago. Social justice and climate change, which were two areas that we got into this business with, but couldn't find the deal flow. Today we can find, not only do we find the deal flow, but we have choices every time we're going in to move something new into the portfolio. So if anyone, I do think we're still a little bit slight on the retail side, but I believe any retail investor who, just like us, if you want it, you're going to get it. You just have to be tenacious and take the time to search the market and find it. And if you have the time to search out an intermediary to get counsel and even just pay them for an initial service to help you identify resources, it's worth it.
So when we talk about deal flow, what we mean, this can be anything from individual companies, private, but it can also, deal flow can also mean that we are approached and offered different types of financial products and investments and so forth. So that's when we use that kind of term deal flow, it's usually that we as private investors and as an intermediary, we look at a number of different companies and assess them according to that criteria. Nadine, what would you say about for people in Europe? What would you recommend people in Europe? Maybe you have advice also for people in other located elsewhere in South America and America to think about how they invest their money. What would be the key advice in, look at these one or two things, look at this carefully, or do this or don't do that?
I would say if we look at for Europe, or especially the Nordics, I would say if you want to invest your own money, most of the funds that exist today in the Nordics, they exclude fossil fuels. And they exclude also the worst controversies and so on. So that has been taken care of, I would say, but that is not about solution. That is not about investing in solutions. So I would say, first of all, there are, in terms of climate change, there are a number of issues. There are so many sectors that are not the obvious sectors. It's one thing to exclude oil and gas. It's another thing most have not looked into, I don't know, cement, aluminium, all these other sectors that where we will have winners and losers going forward. So ask question, how do they assess climate change in other sectors, not to be sitting with stranded businesses. So that's one. The other one, I say, ask about how they assess investment into solutions, because we need to invest in solutions, and there are solutions in the listed space. There are funds in the listed space, and because if you exclude fossil fuels, you have to put your money where it makes sense to put the money, and that's in solutions. So I would ask, what kind of funds do you have to invest in solutions? And there are not many, but there are some, and
I know one point that Jonathan wanted to make, and kind of similar, so I will mention something that he said to me before this conversation, and it's to look at, when you look at someone, a fund or anyone who's talking about climate funds or climate products, etc., they should not just contain renewable energy. It's so easy that we think sometimes that climate is energy and is renewable energy and so forth, but you look at the reasons for the global warming. Right now, a lot has to do with our consumption and our lifestyle and behavior. So we would also encourage you to think about, if you want to invest for the climate, look at portfolios, look at funds that are investing in food technologies, in agriculture, because that's where you have a lot of that, the reason and the background for what we're seeing right now. And
building,
exactly.
Cement, aluminium, steel, all this solution in these areas.
Yes, and when you see the energy efficiencies, and when you can see those who are still a little bit, to your previous point, maybe best in class, but where are those that have been big emitters, and where do you see companies in, so very often when I went to my, and someone who was going to help me with my pension fund and the selection, I don't think necessarily you have to be very financially literate and savvy to start open, because they have to disclose what are the biggest holdings, what are the biggest companies that each fund has. And you can just Google them and start looking at their reporting and what they're doing and what they're saying. Where do they get the main money from, and how, as within Europe, you have the sustainability reporting has to be integrated with the financial reporting as well. So just a little bit of background research on what the bank managers, the asset managers are proposing to you can go a long way. And since Lisa, you spoke about retail and online, I think this is partly part of the movement in giving people the power to start choosing in Sweden, we have the advantage of being able to choose our pension funds, the national pensions, and we can trade and we change. So it gives us the opportunity to change and move it from my own pension in England with my employer. It's harder, it's a trust, and they are managing it differently. But we have a number of tools, I think, as consumers, as private investors, to ask these questions, because it is about asking what is in there and what do they look like. And then actually there is quite a lot one can do to request and see and scrutinize what are in all of these portfolios that we're being offered when it's served as an option for pensions and so forth.
I think you need to make it part of the performance metrics of your investment advisor and your fiduciaries.
Yes.
That's simple. Yeah.
Yes, exactly. I want to show, there's been a couple of, I think you got the links there through that. I also want to say that, Lisa, you referred to Tonic, and that's great. But in terms of resources, I also do find your own website, your family's foundation, the resources you put there. And that can be further reading for those of you who are interested to see how the Kleisner family, the allocation, what type of different assets. And there are a number of examples. When we talk about how should they report and how can it be reported, you have some fantastic examples. And I think it's so great that you share and you disclose and you're very open with, here it seems to work and here it's been more challenging and so on. We also have some of the data that are quoted, World Resource Institute under green targets. You can see some of the performances of the largest bank. If you're interested to just read up a little bit on how the banks are doing and what are the commitments. So you find more information and more data there. We will also publish a book quite soon, trying to guide this second wave of impact investing finance, again, to see what are the type of questions one should be asking. And what can each one do if you're interested to manage your own money and interested to have a more deeper conversation with those who are advising you or those who are helping you to manage money. You have some good questions there as well. I'm going to just check if there was anything else in the chat, anything that you like to bring up or like to ask, etc.
I'm just going to point to one of the resources on our website that I think I would spare. Don't look at anything except the last impact report. And I think you referenced it, Ruth, because that was an opportunity for us to have a third-party person take a look. NPC out of London actually did it, New Philanthropy Capital. And they interviewed our investees, which was interesting feedback for us as investors, where we add value or don't add value. We also took a number of the different impact measuring tools and we mapped them or test drove them on the data from our portfolio. And I think it's sort of a romp through all the different aspects of the owning or stewarding, I would prefer to say, stewarding capital in an impact world. And so I think it makes for lively reading for those people who have trouble going to sleep at night. So I actually think it has some interesting stories. Yeah.
And we had a great question in the chat, which is about what do you say to people who are in a current life space where you live, especially in these times, you're living paycheck to paycheck. One immediate reaction to that would be, I would go, if I only have cash and it's only cash buffer that I would have, I would really consider what are the cooperative banks, the smaller niche banks, the community banks, the cooperative banks, because the community banks, yes, it's like a normal bank account maybe, but it's also allowing social enterprises and communities to get loans for their organizations. So that would be my one piece of advice. What would you say, Nadine, if you're living paycheck to paycheck? How should you think about this?
I think then it's more about how you spend your money buying everyday stuff than going to the bank. Trying to it's unfortunately it's still more expensive to buy sustainable than not sustainable, but maybe every step you can take in that direction and buy fair trade bananas instead of regular bananas or so. It's a difficult question. fully.
Yeah, with food though, as you started mentioning it, of course, going to plant-based options is cheaper than
Local farmers market or so, yeah.
Yeah.
I do think
so
even though
you had another quote. Sorry, Lisa, you said.
Yeah, even though it's paycheck to paycheck, actually, across the United States, paycheck to paycheck represents about 50% of the population. So guess what? This is a voting block. This is a power block. So it's not just about where you spend your money, but it's how you do your politics, right?
Mm-hmm.
Also, I do believe that fair trade bananas notwithstanding, I think local, non-extractive right now to reduce the carbon footprint is just go as local as you can and support local businesses.
I agree, Lisa.
Yeah. There was one more question. Is the difference between, do we have co-ops in the US? Yeah, I bet they exist in every market. I would be surprised where I wouldn't find. There are very few markets where cooperatives and community banks don't exist. So any comment on that, Lisa, on the co-op space in the US?
Yeah, I'm not familiar with a co-op bank in the US actually. But there's a lot of obviously cooperative business models, like REI is a large national company.
When I say cooperative banks and someone referred to the UK, it's slightly different wordings more than the model itself definitely exists in different countries.
And we've worked with cooperative banks in all female owned cooperative bank in India that has something like 10,000 owners. It's fantastic the work they do in supporting, basically providing debt instruments to the women entrepreneurs who are members.
Yeah,
there's a lot of great global examples, but I don't think the US has any that I'm aware of, unless you consider a credit union sort of a quasi form of, but even the credit union, there's no active role for the client.
Okay, great. Just as a closing word, I'd like to thank you all for zooming in and to watch this conversation. Thank you so much, Nadine and Lisa. And we hope we gave you some advice. It's a short thing. It's a big, big topic. If you like to continue engaging this conversation at Impact Invest, we will also be listing some of these resources. So feel free to contact us if you weren't able to see or to really catch all of these advice and resources that were mentioned through the Zoom chat. So thank you very much, and back to Jim.
Thank you, Ruth. Thank you, Nadine. Thank you, Lisa. Fabulous conversation, full of rich complexity. Just thinking as you were speaking, Nadine, you must have to really be an investigator to find out what the actual truth of the matter is with many of these corporate structures, with subsidiaries and wholly owned this and paper company that, and so forth and so on. It must be a real challenge. And Lisa, I want to applaud you. I mean, if you're 100% impact, you're a model for us all. And to be now second generation harvesting 100% into the next 100+% is a noble achievement. So I just want to acknowledge what you and your husband have done through Tonic and elsewhere. I think that the comment I would like to make comes from the last question. What do we do when we're living paycheck to paycheck? And in my view, it's the same question of whether you're a billionaire and you have to make a series of choices. Every choice each of us makes every day is either part of the problem or part of the solution.
Absolutely. Yes,
and I don't believe there are any exceptions, large or small, rich or poor, India, Brazil, China, Vietnam, Poland, or Canada. All of us are in a distended world situation where the cascade of crises is now only going to increase in frequency and in severity. This pandemic is not the end of the story. We're heading right into the whirlwind. When the Arctic is over 100 degrees Fahrenheit, nearly 40 degrees centigrade, we've got a problem, Houston. So one of the things that we are considering as a tagline for Humanity Rising, is proposed by Peter Mary, is proceed until apprehended. That the time has come, whether you're in a capital market or an organic farm or a factory floor or Wall Street, to understand what actually Aristotle said over 2,000 years ago, 2,500 years ago, that ethics is shaped by choices. And this panel has really made that crystal clear. So Ruth, I really want to thank you for convening such an extraordinary group. I'm really sorry that Jan de Dood couldn't make it. I know him personally for many years. He's got a very dimensionalized mind, and he would have added to the conversation, but we'll have him down the road.
I hope.
So I want to thank you. And then just to say that tomorrow, we're going to be diving into the Sustainable Development Goals. We have about 4 people from different parts of the world, again, and different sectors that have been working on the UN SDGs. They're a critical categorization of the central 17 critical challenges facing the human race. The discussion will be very rich and promising. And then because I've been feeling it, Lisa, ever since you told us before the call started about Esalen, I just want to tell people that it's been reported by Lisa that Esalen Institute, in Big Sur, California, has closed, and the property is up for sale.
No, it's not closed. Hold on, it's not closed. It's still doing business, and I think that the sale is the land. The institute is an entity, so it will live on.
Oh, good.
Yeah.
Good.
Yeah. Just clarification.
I'll take it all back. If Esalen, the institute, is still going, then that is
alive and well, and they're reopening in July. I think mid-July. Yeah.
Okay, so what they're selling the land.
Yeah.
Gotcha. Well, that's very interesting, but that means it's still hopeful, because for me, for Esalen Institute, after everything it's done for the last 60 years, really, it's been extraordinary fulcrum of creativity, arguably the most potentiatedly creative spot on planet Earth continuously over several decades. I can't think of another institution anywhere in the world that has had the transformational impact on culture as Esalen Institute. Virtually everything that we now consider mainstream in some way or another in the 50s, 60s, 70s, 80s, 90s went through the labyrinthian pathways of empowerment in Esalen. The whole human potential movement, cultural creatives, all had some way or another birthing through Esalen. So I'm delighted for that correction, Lisa. You've lifted my heart at the end of this session. So thank you, everyone. We'll meet again tomorrow, 5 o'clock to 7 o'clock p.m. Central European time, and convene as usual tomorrow on the United Nations Sustainable Development Goals.
Great.
Thank you, everyone.
Thank you. Bye.
Thank you, Jim, Nadine, and Ruth.
Thanks, Lisa. Thanks, Nadine.
Thank you, everyone.
Thank you.
And Georg in the background, running the show.
Always Georg. Julie.
I'm going to exit. But thank you for the opportunity. It was
Thank
nice
you.
to meet you, Jim. And Nadine as well.
Yeah,
Take
nice
care.
to meet
Nice to
you.
see you, Ruth. Okay.
Yeah.
Aloha.
Bye.
Bye.